everyone, my name is Nontando Mposo and I'm the Glamour Magazine's Editor-in-Chief. Today we are tackling a very important subject of money and tax-free savings. With me I have Sisandile Cikido, who is the head of retail investments at Nedbank, who's going to be talking to us about what is tax-free savings and why should we care about it. The last 2 years with the pandemics have been extra hard on our pockets, and they've made it so hard for us to save money, and it's so overwhelming. You know, most of us, like myself, are looking for ways on how we can start saving, like what's out there. So Sisa, please tell us a bit on how I can start putting away that extra money that I have. I mean, tax season is approaching. Like, what are the options available for me?
Hi, Nontando, and hi to your viewers and your readers. Nontando, I think you hit the nail on the head when you say the last 2 years have been absolutely difficult. We were all impacted by the pandemic financially in some other way,
yes,
whether directly or indirectly, whether you've lost your job or you know someone who has, or now you need to take someone in terms of your family or start taking care of someone extra,
yes,
or a salary cut. So I think it's important that if you are saving, you've got to make sure that that money is working for you. I say to people all the time, when you're sleeping, your money shouldn't be sleeping. Your money should be growing wherever it is. And that's the beauty about tax-free investing, that you're able to actually grow your money, but not have to pay tax on the money that you've grown.
You make it sound like so simple. Can you just like delve into it a bit more for someone like me who doesn't even know where to start? Like, how do I go about it?
So the tax-free investing and the tax-free savings account was introduced by our government in 2015, purely because South Africans are consumers of note, and I'm sure you know this,
yes,
right?
Yeah. They love shopping.
Darling, have you met me? You know, so South Africans are consumers of note, and it's very difficult for South Africans to save. And I mean, we also know the economic plight that we're under, and this was even prior to the pandemic. We are sitting at the highest unemployment levels we've ever seen in the country, over 30% unemployment. However, there are South Africans who do save, and I think the government has also tried to make it more attractive for us to save, right? And it's really not that difficult, because you can start with very little money, and you can start whether it be digitally, whether you walk into some sort of a branch or you contact someone.
Yes.
But I think it's important to put away your money where it can earn money and not cost you any money. So essentially, if you put money away and you invest it in anything, and it grows, except for putting it under your mattress. And I don't know if you trust yourself like
yes,
this. I find shoes, so mine doesn't grow under my mattress. But if you put your money away and it earns interest, you are then having to pay tax on the interest earned if you've gone over your threshold. So your threshold, tax threshold, as someone who's under 65 would be around 23,800, I think, but that was 2021. And if you're over 65, it goes a bit higher. But my point is that if you get to that threshold, you then start having to pay capital gains tax on that. So in a tax-free investment, it's completely different. You don't have to pay that kind of tax on the investment that you've made, or rather the interest that you've earned.
That's interesting. And like most people, when you hear the word investment, you think that you have to have a big amount, you know, to start with. So is there like a fixed amount that I have to have in order to go into tax-free savings?
So with the Nedbank tax-free savings account, you need as little as 500 Rand. And you can put in your tax-free savings account and really start growing your money.
Yes.
However, the annual threshold is 36,000 Rand a year. So ideally, you should be putting away 36,000 Rand a year so that you can reach your lifetime goal in a couple of years, or rather your lifetime threshold of 500,000. So, but you don't have to put away 3,000 Rand a month, which is your 36,000. You can start with as little as 500 Rand. And I think it's about the discipline. I always call it the psychology of saving. I call it the psychology of saving because I don't know if you grew up the same, but I grew up in a community where there were stokvels and burial societies.
Yes,
and they didn't put much away, you know, but there was so much discipline. I remember my mother would be, before she pays anything, it's like, society. you know?
And yeah, that's such a good comparison, because at the end of the year, like, you see the groceries coming in and you're like, wow, from as little as 100 rand.
Exactly. So I really do believe that if you can start with as little as 500 rand, you start topping up from as little as 100 rand after that. It's the psychology. Get it into your head to start saving and start paying your future self first.
And like, when we put it into perspective, so what's the time period that I need to, just before I enter into the savings plan, I need to look into, like, let's say from 10 to 15 years? Like, what are the gains looking at that period?
So if you were to hypothetically reach the threshold that I spoke about, well, not the threshold, but the annual sort of limit that you have, which is 36,000 Rand as an individual. And in a favorable interest cycle, I mean, we did the calculation a few years ago. Obviously, our interest cycle was much better at the time. Yeah. But over a 15 or so year period, you would have reached, firstly, you would have reached your lifetime contribution limit of 500,000, and that money would have grown because you don't withdraw from it, right? The schlep about tax-free is that if you take anything out of it, you can never put it back. So whatever you put in there, it is important for you to leave in there and let it grow. Let your interest compound. And you know, the glorious thing about compounded interest is that you earn interest on whatever you've earned. So you let that money roll over a 15-year period. And I think at the time we'd calculated just over R1 million that you'd be sitting on. But like you said, investing is investing. It takes time.
Yes,
you know, so you need to really just give it the time that it needs.
Now that I understand a bit more clearer, and like it's something that's feasible if you put your mind into it long term. And what are the rules that I should know about beforehand, before entering into tax-free savings? So
a tax-free savings account, as amazing as it sounds, which, and I really do believe it is, you do have to be careful. Any kind of over contributions will be taxed. So at a rate of 40% of whatever it is that's over. So hypothetically, you contribute 40,000 for the year instead of 36,000. The 4,000 will be taxed at 40%. However, I think a lot of institutions like Nedbank have made it very easy. They don't allow you to over contribute, and this is sort of the 36,000 Rand limit is across all institutions. So you can't have 36,000 at Nedbank and then 36,000 somewhere else. So that's one. And then another rule is that your lifetime limit is 500,000, because ultimately government also needs to make money. But the glorious thing about, like I said, the compounding effect of you leaving the money in there is 500,000 is actually all you need to contribute if you're going to look at this as a long-term investing instrument. So if you're looking at it, I look at my tax-free savings account and is part of my retirement plan. So I may not look it, but I'm not going to be in this thing forever. You know what I mean? So in the next, say, 20, 25 years, I have a nest egg that is going to be part of my retirement sort of planning and my retirement savings, which is going to be awesome. And I think that's how we always need to look at tax-free. It's about long-term investing. So I think those are the key things. Stick to your limits, don't over contribute, and do not take money out. Because if you contribute 36,000 Rand, take out the 6,000 Rand, you can never put that 6,000 Rand back in. It will be seen as an over contribution.
Absolutely, that makes sense. And one thing for me, before I sign up for anything, I want to know the process. Will I have thousands of forms to complete? We know we'll have to go through a background check financially. So what is the process like if I want to sign up?
Absolutely don't need a background check. I swear to you. You could even have some skeletons in your closet. It wouldn't be a thing. But I think we've made it very easy for Nedbank clients, particularly that you can literally open up a Nedbank tax-free savings, tax-free fixed deposit, or even a tax-free unit trust using the Nedbank Money app. If you are a new to Nedbank client, you are able to do it on the on nedbank.co.za, so our online banking platform. You can actually open up a tax-free savings in less than 2 minutes. If you aren't as digitally savvy, you can contact our contact center, the Nedbank contact center, or walk into any branch. So it really isn't a laborious process. I think I did mine in less than 2 minutes. It was actually a minute and a half that I could open on the Money app. So it really isn't a difficult thing to do.
And like going back to my intro, like the past 2 years has literally showed us flames financially. And I want to catch up with my savings plan. So what would you suggest? Like, what do I look out for in terms of like bad investments, and how will the tax-free option benefit me?
So I think firstly, I think now, to your point, because we've lost so much in terms of traction, right, when it comes to money, everyone's looking for some kind of get-rich-quick scam, and I'll call it a scam because it is. If it sounds too good to be true, it really is. Like our parents used to tell us all the time, no, you know?
Yes.
So if it does sound too good to be true, please do double tap on it, do the research. I'm not saying use traditional investment instruments all the time, but I think do your research. You owe it to yourself, you owe it to your money. Secondly, like I said earlier, if your money is sleeping while you're sleeping, you're doing yourself a disservice. Ensure that you moved your money from like a current account and put it in an account where you're going to be earning interest that is at least competitive. And then I think another thing is that I always say you don't need anyone to destroy your financial future. You can do it all by yourself. I mean, I'm capable. I told by myself. I'm extremely capable. I can take money, I can spend it. I really know how to spend money. So automate your savings. Save your money from yourself and start paying your future self first. And by that I mean, before you start spending, before you start paying for things and you start going out and doing whatever, take that money, take 500 Rand, start off with a small amount that is palatable and put it away, but do it automatically. So I have stop orders that go off my account every single month. So I don't even have to think about it. Because if you have to remember every time you get paid, you're going to be like, no, not this month. You know, I need to do this month. But before that money is even settled in my account, it's gone. So I think automating savings also really helps. And we've got to budget. It's that terrible B word. You know, we've really got to budget. Understand what it is you owe. Start paying that off. Increase your repayment so that you can get out of short-term debt really quickly. Make sure that you pay for things like your assets, and then put your money away and save it where you can.
And just like there's always a question of, like, let's say, like I've been working for a while and someone who's just entered the job market, and there's like, should I really save now, or should I like shop up a storm before I really think about saving? So what would you say? Is it ever too late to start saving, or how can I start immediately?
I think it's absolutely never too early to start saving. I started working when I turned 20. And instead of saving, I did the opposite. So exactly what you're saying. I was spending up a storm. I was raking up debt. And if I could do anything, you know, there's these memes on social media. What should you do to your younger self? I slapped myself 10 times on Sunday. But like, it's never too early, because the last 2 years have shown us no one could have seen COVID coming. And that's the beauty about saving, right? You've always got some kind of a cushion. And the nice thing is as well, it's nice to not get into debt. So think about it. If you're going to go away on a holiday, if you're going to buy shoes, isn't it better to just pay the cash price than pay that plus? Because you've taken it out on debt. And just the discipline around planning for things and putting goals towards your savings. My goal is I am going to Ibiza with my girls, hypothetically. You can save for that rather than put it on credit, right? So I think it's important to have different baskets of savings, your sort of immediate emergency funds. You want to have your long-term funds like your tax-free, and then some things for your goals. You might be buying a house. You want to be able to get into the discipline of paying for your bond before you have to pay for that bond. So it's important to save no matter how young or old you are, and it's also never too late.
Thank you so much, Sisa. That was very informative, and like I'm already thinking, I need to start. I need to like catch up with what I've lost. And this is quite like the tax-free investment from Nedbank has given me a good option.
Thank you so much.
Thank you,
for
Sisa.
having me.